In this video, we explain our very efficient double RSI trading strategy, which is both simple and easy to understand. We'll walk you through the process of combining this powerful method with price action tactics, allowing you to create a custom trading system that meets your specific needs. This video is jam-packed with useful insights and practical ideas, so watch it in its entirety to get the most out of it. Let's get right in and start optimizing your trading strategy. Basics of RSI. The Relative Strength Index, or RSI, is a momentum oscillator that measures the speed and change of market movements. As an oscillator, it produces values ranging from 0 to 100, with a preset computation period of 14 periods. This RSI calculation compares the current price to the price from the previous 14 bars. When you shorten this interval, say to 7, the RSI becomes more sensitive, resulting in more extreme readings. Extending the duration to 30 makes the RSI less sensitive or slow, resulting in fewer severe results. These extreme readings are critical for interpreting and forecasting price fluctuations. When the RSI exceeds 70, the price is considered overbought, implying a bearish reversal is likely or downwards. When the RSI falls below 30, the price is deemed oversold, signaling a possible upward trend reversal. However, the overbought and oversold circumstances might change based on the current trend. For example, in an uptrend, the overbought zone may move from 70 to 80, while the oversold zone may shift from 30 to 40. In contrast, in a downtrend, the overbought zone may fall to 60, and the price may remain oversold moves to 20. These overbought and oversold zones are only references to current price levels. They are not trade indications in and of themselves. You should never trade entirely based on these zones. Typically, during an upswing, the RSI can remain in the overbought zone for extended periods of time with no retreat. In such instances, placing sell transactions simply based on overbought conditions might lead to losses. Nonetheless, the price frequently respects overbought levels greatly in an uptrend. When the price approaches the oversold area, an upside reversal almost always occurs. The same idea applies in a downtrend. In a downtrend, prices tend to remain oversold for extended periods of time with no pullbacks. Buying here will result in losses. However, the price tends to respect the overbought levels significantly. When the price approaches overbought levels, it nearly usually reverses. The dual RSI trading strategy takes use of this behavior. Additionally, RSI can be used to identify market trends. A simple way involves marking the 50 lines on the RSI chart. If the RSI is greater than 50, the price is often thought to be in an uptrend. Conversely, if the RSI falls below 50, the price is considered to be in a downtrend. However, during moments of market consolidation, the RSI typically hangs around 50, occasionally crossing it, making trend identification difficult. To address this issue, we can use the 60-40 method. In this method, we identify the 60 and 40 lines on the RSI. When the RSI rises above 60, we consider it an indication of an uptrend. Conversely, if the RSI falls below 40, we consider it to be a downtrend. When the RSI falls between 60 and 40, we consider the market to be in a sideways trend. Pretty straightforward, right? Now let's look at how to combine these ideas into our trading technique, dual RSI trading strategy. This method is a trend trading approach that works best when the price is moving in a direction. Trends generally produce huge swings in the trend's direction, with each swing divided into two parts, an impulsive move and a corrective move. For trend traders, the best moment to enter is around the end of a corrective move, by entering at this price point. You position yourself to capture the next impulsive move, so we try to find an entry here too. To accomplish this, we must focus on two crucial tasks. Identify the trend, identify the entry. We'll use the RSI to complete both jobs. First, add two RSI indicators to the chart. To represent the daily chart values, set the first RSI's period to 7 and the time frame to 1 day. Set the overbought and oversold boundaries to 60 and 40 respectively. Make sure to change the color of the RSI lines to distinguish between levels. For this video, I'll use orange for clarity. The orange RSI will help you detect the market trend over a longer time frame. If the RSI is over 60, the price is deemed to be in an uptrend, so we will look for buying chances. If the RSI falls below 40, the price is considered to be in a downtrend, and we will search for selling chances. The second RSI will assist us pinpoint entry points. For the second RSI, set the period to 7 and the overbought and oversold thresholds to 60 and 40 respectively. Once these settings are specified, your chart will be ready for examination. Let's go over the rules of the strategy. Because the dual RSI technique is a swing trading approach, we use the 1-hour chart to enter and exit positions. To begin, we need to identify the market trend. For this, we'll use the orange RSI on the chart. If the orange RSI rises over 60, the price is in an uptrend. In such a scenario, we will hunt for buying possibilities. Next, monitor the second RSI and wait for it to fall below 40. In this scenario, the price was oversold and we saw two doji candles. Additionally, the price is approaching a support level. These factors indicate that the price is going to revert and rise. The third step is to wait for the RSI to rise back over 40. The next candle was a massive green one, with the RSI rising above 40. Although theoretically this was our entry point, the size of the candle renders it unsuitable for trade. If we entered at this moment, our stop loss would have to be lower than the most recent swing low, resulting in an excessively broad stop loss. So we wait for a couple more candles. The price rebounds to the support level and becomes oversold again. This time it creates an engulfing candlestick pattern. As the RSI rises above 40, this situation is regarded as extremely favorable. We enter a buy trade at the conclusion of this candle, with a stop loss below the swing low and a risk-reward ratio of 2:1. As demonstrated, the price met our target on this trade. Now let's look at a sell trade. On this chart, the orange RSI is clearly below 40, indicating that the price is declining. In such cases, we should explore selling opportunities. When the price pulls back and the RSI rises above 60, a selling opportunity presents itself. We see the price stall and then go downward, with this little reversal taking place at a resistance level, adding to the confluence. We enter the trade when the RSI falls back below 60, with our stop loss above the swing high and a risk-reward ratio of 2.1. As you can see, the price met our aim for this trade, and it is the strategy's most basic version. Remember, just because a plan is simple does not mean it will be unsuccessful. As a trader, your job is to improve these concepts by incorporating your own knowledge and observations. That concludes this video. If you found it informative, please like it and subscribe to our channel, Trader Yoda, so you don't miss any future videos. See you soon.